You can have a statement that changes completely. I mean, June was completely different from April in the same quarter. June was one of the strongest months ever because as soon as the optimism, the risk-on came back with the US-China trade agreement, people came back. So it's a tough environment to navigate and very hard to predict. That's why our outlook is I concede, relatively mixed, but because the reality is.
Sure. Let's talk about that 10% return on tangible equity target. Very few people actually thought that you were going to hit it this year. The market, the analyst community, you did it. You hit it this year earlier than many people expected. How sustainable is it, given that we're seeing difficult revenue trends?
It's really, thank you, it's an important point. We've been very clear, actually, but it wasn't a target. What we said is if revenues in 19 are flat versus 18, we have created a platform that can generate 10% return on equity. And we chose each of those words carefully. The problem with return on equity targets is that they are revenue dependent. And very often, when a bank puts out a return on equity target, there is embedded in there some kind of revenue growth hypothesis. And we did not want to be in that position. So we picked the number that we could hit without revenue growth. So clearly, it's revenue dependent. You saw in the first quarter where revenue were very much under pressure, we did 8%. So we're not claiming that we can hit that number no matter what. We think it's an indication of the quality of the platform we have out of the restructuring. We also think we can go much higher than that. We said 11 the following year, 12 the following year, and that's a function of particularly the growth in wealth management. We added 100 billion in 6 months. Well, that's a lot of future revenue because that 100 billion will stay with us and will generate fees every single quarter. So as we grow, that ROTE, the 10%, will grow.
Let's talk about wealth management and the net interest income. You've seen a tailwind from rising U.S. interest rates over the last 3 years. That might be about to change today. For the first time since the financial crisis, the Fed might be cutting interest rates by 25 basis points or even 50. How sensitive is your business, your U.S. dollar-denominated business, to that? How painful is it going to be? And similarly, your euro-denominated business when the ECB makes another cut.
It's a very interesting point. If you observe, we have actually underperformed during the period of rising rates because our whole strategy is to not be just a play on the yield curve. So we are much less exposed to the yield curve than some of our competitors. So the recent period has been a bad period for us. If you look at the US banks, it's a really important point. I will insist on 90% of their increase in revenue in the last 2 or 3 years has been exclusively due to the yield curve. So we read every day articles that we cannot compete, we don't know how to compete. 90% of increase in revenue has been yield curve driven. And 50% of the decrease in revenue for European banks has been yield curve driven. So a lot of the press that's written about the divergence in performance is due to yield curve and taxes. So we are less exposed to that. So for once, when the yield curve goes down, that's a benefit for us because we will also lose much less than peers, and you're starting to see some of that come through these numbers. We are less exposed to the yield curve. We don't have a huge consumer lending business. We don't do credit cards, we don't do cars. And we really very much in wealth management, in taking assets, managing them, generating recurring income, generating transaction income. So NII is important. Actually, where it's the most important is Switzerland. Right? Outside Switzerland, it's not that important, not as dominant. And in Switzerland, we are going to take measures to drive it up. You've seen us make a real estate sale in Q2. We think that's completely legitimate because when interest rates are negative, real asset prices go up. So tactically, it makes sense to capture that. But more generally, we are going to take measures to change how we treat deposits above a certain level. Because we have to protect, again, the net interest income.
Very quickly, does it make sense at all to ease again when you look at the world's central banks? Will it help the consumer? Will it help the economy?
Look, for my sins, I do come from the life insurance industry, and I'm no great fan of low interest rates. As a great believer in the importance of savings in the economy, subsidies to debtors and penalty for savers, I think in the long term harm the economy.
Hi, I'm Joanna Bersecci, and thank you for watching. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to our channel for more from CNBC International. Thank you for watching.